All of this is global, and a lot of it is also reflected in India as well. So when you look at the Indian economy, before COVID as well, the economy was actually kind of grinding. It was neither growing very fast, neither slowing down. It was just about grinding and kind of plateauing. And the key reason for that was a lot of policy reforms that we actually expected the government to do. They actually did, and because of that there were a lot of headwinds that got created. For example, demonetization happened, and there was a complete reset of the MSME sector. We had GST, which again kind of was a much needed reform that took place. It actually had an impact in the initial phase on the businesses that actually run the show. At the same time, we were actually the monetary and the fiscal stance was also quite hawkish, and was also a kind of a deterrent to growth. But all of this was actually necessary requirement that we wanted to happen, and it did happen. But the natural corollary of this was that there was a slowdown that was getting impacted. So as I said, informal sector was getting hurt. Corporates were actually focusing more on deleveraging rather than trying to grow their balance sheets, and capex led to private capex slowdown. Banks, if you look at it, this is basically a reflection of the health of the economy. They were suffering because a lot of NPAs had piled up on their balance sheet, and they were also kind of. So it was like before COVID, the whole economy was kind of stabilizing and kind of digesting the excesses of the last cycle, and there were a lot of so to say, pulls and bears of how where to. So there was it become the growth had become very narrow. It had become very stock specific, sector specific, and then in that environment we got hit by COVID. So while our response to COVID was one of the strictest lockdown and the longest lockdown in the world, it was however, at the same time, while the response to COVID was very strict, very long, and it protracted, the good thing was that the monetary policy actually was very accommodative. They cut interest rates, they infused liquidity, all of which what I talked about, what happened in the global markets, exactly same thing happened in India as well, which is why you see that what happened across the world in terms of stock markets, the exact same thing happened in India as well. The good thing is that both monetary and fiscal policies are now accommodative. They are in a stage where most of the reforms that were required to be done are behind us, in terms of GST, in terms of corporate tax, in terms of labor law reforms, agri reforms, land reforms, in terms of RERA. A lot of these reforms which were required are behind us, and now we are in a stage where we are actually becoming more accommodative for growth in terms of both our monetary and fiscal policies. So now, having all digested all this, now if you look at in a post-COVID world, we are looking at a more growth oriented outlook for the economy. It's like we were flying at a very high speed, then we kind of stabilized, and now we are again ready to take off. So we saw the budget, like in the last budget, you saw that fiscal deficit was expanded by a wide margin. Typically, whenever we've seen fiscal deficit expand, economy tends to respond with a year's lag, but growth kind of picks up quite a lot. We are obviously seeing lower cost of capital. The cost of borrowings are at a historic low. So borrowing and next capex cycle will kind of kick off with this. And at the same time, the government has actually come up with this Atmanirbhar program where they are promoting manufacturing, job creation, and reduction. So if you look at it over the last 10 years, what we've seen is that the excesses of the GFC and post 2008 to 13 level, we had a lot of high growth which got stabilized. A lot of consolidation happened in terms of reforms, and now we are in a stage where we're believing that the growth will pick up steadily. For the next grow, there are two aspects to this. What is likely to happen over the next 18 to 24 months, and what is likely to happen over 5 to 10 years. In the next 18 to 24 months, we believe that GDP will revive. Of course, the direct, indirect fiscal monetary stimulus that I talked about is kind of helping it to revive back. We we were very lucky actually, if you look at it from that perspective, that we've had two very good monsoons back to back, and the third monsoon, which the IMD just came up with yesterday, is talking about third year in a row where monsoons are likely to be normal, and normal, and in terms of the long period average. This kind of gives support to a very large section of the population. It provides a lot of support to the rural economy. So this is quite positive from that side. And another important aspect is the lower interest rates is actually is supporting a lot of affordable housing sector. Housing sector is one of the most important sector from an economy perspective, because almost 200, 300 industries are kind of linked to the housing sector, be it steel, cement, paint, tiles, wires, cables. I mean, fans, consumer. You can keep on going on and on as to how, you know, an upcycle in housing can lead to a much higher growth in the economy as a whole. And the biggest deterrent for housing sector to pick up is the cost of capital, which is actually at a lifetime low. So I think there are the right ingredients for growth to pick up going forward. They are all in place now. I said meaningful reforms into attract investments and capital in India. This is led by you see the PLI scheme. It's a case study in itself. How over the last 3 to 5 years we've kind of become from a net importer of mobile phones to a net exporter of mobile phones in a matter of just 5 years. We've been able to achieve this. It's a remarkable case study, and maybe it's a matter of point of discussion on its own how we've been able to turn it around. We are trying to do the same thing in a lot of other sectors where we are basically a net importer, and with the Atmanirbhar program and the PLI schemes, we are trying to turn around that in net import into net export. This is likely to kind of, you know, push a lot of manufacturing into the country. We've already seen a lot of projects being awarded, and the good thing about the PLI scheme, unlike in the past where we had some SEZ schemes and some or the other form of tax, this time instead of being more democratic in terms of giving opportunity to everyone, what this government has smartly done is this time they are giving it to the bigger companies which have bigger balance sheets and access to capital and Global Connect. These are the companies which are being awarded these PLI scheme capexes. So the possibility of these to actually get executed on ground is far more better and higher. And to that extent, the schemes should likely do much better than what we have seen in the past. Similarly, if you look at it, the corporate tax structure, that spoke about a lot of reforms that the government has done, both in terms of direct and indirect taxes. All of this is kind of, you know, getting you that incremental optimism that is required, or the risk on appetite that is required in terms of you to start expanding the business. And we have all this in place now. And the last and the most important part is what the central bank is doing. So, right, central banks have cut interest rates, they have increased liquidity. All of these are very conducive environment for businesses to kind of expand. And when businesses expand, you find that economy grows, and so does the stock market along with it. Over the next decade, if you look at it from the next 5 to 10 years, there are basically 4 factors of production, right? Land, labor, capital, and entrepreneur. And this government has actually tried to touch upon each and every aspect of it, be it the agri reforms, be it the labor reforms, be it the tax reforms, be it the manufacturing push. All of this is kind of being worked upon. None of these are likely to give you any benefits in the next 12 to 18 months. But of course, over the next 3 to 5 years, or maybe 5 to 10 years, all of this we will probably be, after 5 years or 10 years, we'll be talking about, okay, this was the government who did all these reforms, because of which all the benefits are getting accrued to us. So I'm very optimistic about what the government is doing. Maybe it's not visible today, but I believe it is kind of putting in the seeds for the right kind of growth over the next 5 to 10 years. This is more on whatever I spoke about. So we are in a pro-cyclical phase where global reflation is happening because of higher liquidity, because of higher prices, and because of capital flows. All of these are kind of driving a reflationary trade in the world, which is reflected in the markets, and which is will get reflected in the economy as well. Similarly, when you look at domestic markets, RBI's balance sheet, you look at it, it has expanded materially over the last 1 year. Similarly, if you look at liquidity, we are in huge liquidity surplus. The amount of money that is parked with the banks and the record low interest rates are just is an outcome of the liquidity that is there in the system. So is it also reflected in the corporate bond spread. As I said, the cost of borrowings have materially fallen from the levels where they were 1 year back. All of this is kind of enabling are enablers for growth going forward. As I said, fiscal policy also has been extremely favorable. This year we had almost 6.7% fiscal deficit, and the government has not only increased fiscal deficit for 1 year, they have actually the glide path towards FRBM targets have been expanded till 2026. So it just goes to show that over the next 3 to 4 years, we will continue to have a very expansionary fiscal policy from the central government. Similarly, banks' balance sheet, as I said, large part of the banks were suffering from NPAs, and they were more in consolidation phase, reducing, focusing more on retail. All of that is kind of behind us now. That despite the pandemic, if you look at it, the net NPA, GNPA numbers are quite lower than what it was probably 3 years back. So we are on a credit cycle is likely to revive going forward as well. This is what I was trying to extend. Fiscal expansion, if you look at it, the last fiscal expansion that we had was during the 2009-2010 phase, when we were hit by a GFC. And so 2009 and 2010 we had 10% fiscal deficit, and you look, the growth actually revived later on. So today the fiscal deficit that we are seeing today will reflect in growth going forward. That's how fiscal deficit and growth kind of have a direct correlation with the lag of about 1 year. The good thing about this fiscal expansion is more focused towards capital expenditure, and that is why you see the fiscal deficit expansion is more glued towards capital formation rather than subsidies and salary and all those interest payouts. The biggest indicator of how gradually the economy is improving is the fact that you look at GST collections, because GST collection is one data point that can that encompasses the entire economy, whether it is services, whether it is manufacturing, and it captures the entire value addition through the chain, right? So instead of looking at bits and pieces of whether this industry is doing well or that industry is doing well, when you look at the GST collection number, that will give you a very good indication of how the economy is performing. And we have seen that GST collections are actually at a lifetime high, and also on a YOY comparison basis it is improving. The more encouraging part is that the number of people filing GST is also kind of increasing by the year. So that kind of goes to show that more people are coming on board in terms of being GST compliant, and more sectors are getting GST compliant. So this number, I think, over the next 3 to 5 years, as more and more people kind of get covered into this tax system, this will be the biggest indicator of biggest indicator of the health of the economy. A rise in GST collections will indicate a good growth in the economy, and fall would also mean the same. So I think this is a number which, as an outsider, you should generally look. This number comes every month, so will give you a very good indication of what is happening in the economy.